Hello and welcome to this very special interview series on Moneycontrol. I'm Mahalakshmi and I have with me Upasana Chachra, Chief Economist for India at Morgan Stanley. Thank you so much, Upasana, for joining me today.
My pleasure. Thank you for having me here.
So, this year, we have had a fantastic year in terms of growth. Going into next year, what do you see as the key drivers for growth?
Yeah, the recovery for the economy since the pandemic has, taken a good form now as we, move further away from the pandemic-led disruptions. What we are seeing in terms of high-frequency data is that this recovery is getting more broad-based. As the economy has fully reopened since March of 2022, consumption has been picking up pace. We are seeing services consumption also leading the recovery, especially in the last couple of months, and also manufacturing and investment growth now taking also showing some strength. The weaker points in high frequency data are essentially external demand or export growth, which has moderated in line with what we are seeing on global growth and global growth slowdown. As we look into fiscal 24, we think that the key for India's cyclical recovery will be improvement in the capex outlook, and we think that all the ingredients are in place for the capex growth to pick up from here. As we discussed, end demand is improving, capacity utilization rates are now rising, and private sector balance sheets, both for the corporates and also for the financial sector, are the best in the last decade. So we think that this, coupled with what the government is trying to do through production-linked incentive schemes and other measures to promote investment-led growth, is setting the stage for a capex recovery, especially private capex recovery. And we, therefore, we think that this year, fiscal 24, will also see relatively healthy growth rate. So we are expecting growth at about 6.2% in fiscal 24. That would be a tad better than what trends we've seen, especially as we entered into the pre-pandemic, into the pandemic where growth was slowing. So we are constructive on the cyclical growth outlook and going into fiscal 24 as well.
Sure. So when you talk about cyclical recovery, what evidence are you seeing on the ground, Upasana? And the second point is, you said capacity utilizations are at a level from which we can build on. What does past trend really show? Because right now across the board, if you see average capacity utilization across industries, maybe about 70% or so. Is that good enough for you to start building and adding capacities?
Sure. So, look, the high frequency data, as I mentioned, if you look at it on the, in terms of what's happening on the ground, if you look at PMI manufacturing or PMI services, they tend to, they continue to be above the 50 or the expansionary level at expansionary levels. PMI manufacturing and PMI services have improved sequentially in the month of December. We're seeing improvement in credit growth, and this credit growth is not just sort of retail or personal loans led, but also now industry credit growth is picking up. So I think there are broad-based indicators coming through which are showing improvement in domestic demand. On capex and on capacity utilization rates specifically, well, you're right. At the capacity utilization rates should move towards closer to 78 to 80 if you look at past trends,
Right.
wherein capex starts to kick in. But at the moment, the levels have improved, so they are no longer at 70. If you look at the RBI's data for manufacturing capacity utilization rate on a seasonally adjusted level for June quarter, it is above 74, 75 levels, and it is basically improving in the last 2 to 3 quarters. So we think that as this end demand sustains at relatively healthy levels, and therefore capacity utilization rates will further pick up. And I think we need to keep in mind that we haven't, India hasn't seen a capex cycle in the last 10 years. So with those very low levels of capex currently, or capital stock currently, if end demand picks up, capex or the incentive for businesses to invest will surely start to kick in.
Sure. And how do you see the consumption side? Because up until even a month back, companies were saying that rural demand is not picking up, and that continues to be a stress point. But now after the Rabi season, obviously there is greater level of optimism that that stress point might just get resolved very soon. What is your own sense? Have we really put behind this rural stress?
So rural economy data points, I think, have been a bit mixed, and there is concern, as you've rightly pointed out, in our conversations with clients or and otherwise as well, that there is concern about how rural economy is likely to shape up. We put out a rural high frequency indicator, so we basically try to collate whatever we get in terms of high frequency data points related to rural demand, and the same is showing that probably the worst is behind us. There is, I wouldn't say that it is improving at a very rapid pace, but it has now become more steady, and sequentially things are a little better than what they were 3 to 4 months back. Some of the data points, I think, which will help us to get a sense of how rural economy will pan out are basically things, basically the normalization of the labor force in the rural economy. So we know that the pandemic had a lot of disruptions, especially for the informal or the rural part of the economy. But as the economy opened up and as the services side and the informal side started to, operate at full capacity, that normalization in the labor force has started to take place. And what we've seen is that there was a jump in the proportion of farmers in the overall labor force that is now back towards pre-pandemic levels. So I think there would be some lag in terms of the benefit of that accruing in the real economy, but we think that will start reflecting in the coming months. Secondly, the terms of trade for the rural sector had also been adversely impacted because non-food inflation was picking at a faster pace than food inflation, and that meant that the rural economy's terms of trade were deteriorating quite significantly. But again, now as we've seen, global commodity prices have started to moderate sequentially. That indicator again is also stabilizing or rather improving. So we think that turn will also help the rural economy. And lastly, I think the government spending in the rural economy, even currently, it is off the pandemic highs, but it is still above pre-pandemic levels by close to 1% of GDP. So there is still some support going into the rural economy, which is benefiting or will support the demand. And as you pointed out, the forward-looking indicators for winter crop sowing in terms of the cash flows that could come in look quite good and robust, and we think that as we go further into the year, rural related government spending, especially capital spending in rural infrastructure, should pick up as we especially enter the second half of this year and closer to elections next year. So we think that the worst for rural economy is behind us, and we'll gradually start seeing signs of improvement basis these drivers.
Sure, sure. That is encouraging. Now, what is your expectation from the budget, from all the evidence that we are showing, that we are seeing on the ground in terms of how growth is picking up across the board? What would you expect the finance minister to really do in this budget that could actually nurture the growth going forward into this year?
So from the budget for fiscal 24, what we expect is that it will balance fiscal consolidation while keeping an eye on growth. And by this I mean is that we expect the fiscal deficit to consolidate by 50 basis points in fiscal 24. So we expect the target to be set at 5.9% of GDP. But we think that the funding for this consolidation will be driven by reduction in subsidy payments. So subsidy spending as a percentage of GDP currently is tracking at close to 2 or up a little above 2% of GDP. We expect this will revert towards pre-pandemic trend of about 1.3% of GDP. So that opens the room for fiscal consolidation. And at the same time, what that means is that capital spending can still grow at robust levels. So especially in the last two budgets, that has been a key focus area. And we think that capital spending by the government on its own account can rise about 15-16%, and that will mean that capital spending as a percentage of GDP, the ratio then moves a little higher again going into fiscal 24. So that we think would be the best way to support both the cyclical and also the medium-term growth potential of the economy.
Sure. So in terms of fiscal deficit target itself, I think your estimate is 5.8% for FY24. So is that your most, the realistic target, and what is the best and worst case?
We are at 5.9 actually.
Okay.
Yeah, that's our, that's what we expect in terms of what a credible fiscal consolidation path can look like. So we think that 5.9% of GDP for fiscal 24 will be par for the course, given there is a need for the economy, for the government to continue with its focus on capital spending. So with the reduction in subsidy payments, they'll be able to fund this fiscal consolidation and still ensure that capex continues to grow at a high level and supports the growth outlook.
So can you sort of put some light on this budget math itself? Because two things that will probably work against the fiscal balance going into next year is, one, tax buoyancy this year has been exceptionally good. So getting into next year, obviously, if nominal GDP growth is going to be lower because inflation will be lower, then that number may not be as good. Second thing is, going into election year, as it is, the disinvestment track record of the government has not been very encouraging in the past few years. Going into next year, it might be even more difficult because we are heading into elections. So if these two numbers were to contract, how do what kind of maths will have to be in place to ensure that you're also able to increase public spending by 15%?
Uh, so you're right. Nominal GDP growth will be lower in fiscal 24, driven by lower inflation or the deflator. We're expecting nominal GDP growth to be somewhere around the 10.5 to 11% mark. But on the tax revenue side, that means is that nominal growth of tax revenue collection will, yes, be lower. But we think that tax revenues to GDP, the ratio will be steady. So we're looking at gross tax revenues to GDP to be about 11.2% in this year, and we expect that to be sustained going into next year. So buoyancy, in our view, remains largely steady because, as I mentioned, we are constructive on the cyclical outlook. We do think that GDP growth will sustain above 6% levels, and that will ensure that there is some underlying level of tax buoyancy which is retained, and so tax revenues to GDP remain steady. Divestments, yes, we agree. We are also not very optimistic in our assumptions for fiscal 24. We think the number realistically would probably be close to 350 odd billion. Which obviously is not a very large sum in the overall math for the budget. So we're pegging that at about 350 billion. The key to the spending part is actually that capital spending grows by about 15-16%,
Right.
while revenue spending is actually lower, driven by lower subsidy payments. So that's how we look at the budget math to pan out for 2024.
Okay. And where do you see these cuts? When you say rationalization in subsidies, where do you see that happening?
So food and fertilizer subsidy mainly. So if you look at the food subsidy and that's got restructured, that in itself will give you a savings about 20 to 30 basis points and a similar quantum in fertilizer subsidy. So both have ballooned this year. Food subsidy due to the free food program that extended up to December of last year. But now that has been discontinued and that opens up a lot of space. Otherwise, those numbers could have become sticky and therefore a bit worrisome. Fertilizer subsidy obviously is a function of market prices. Fertilizer prices also are now moderating, so sequentially down and also YOY down, about 30 to 35% if you look at various types of fertilizer prices. And I think that again gives you the quantum that fertilizer subsidy could also be down about 30-35%. That's where the saving stems from. Revenue expenditure ex interest ex subsidy we think will remain flat as a percentage of GDP. So we don't really expect a major boost coming in the form of higher redistributive spending. We think there will be a need to maintain that in line with nominal GDP growth.
Sure, fair enough. So if you look at the street, Upasana, I mean, most fiscal deficit forecasts for FY24 ranges between 5.8, 5.9. Some of them may even think about 6, but 5.8, 5.9 it is. What do you think is the level that the market can digest? In a worst case scenario, will they be okay to take a slippage in their stride?
I think as we are moving further away from the pandemic and the pandemic-led disruptions and the growth recovery is showing that it is, it is quite healthy and sustaining its momentum, there's definitely a need to consolidate the fiscal deficit. Therefore, a slippage on the fiscal deficit side, which, with the starting point itself is so elevated, will probably not be something which, in this current environment will be agreeable to the markets in our view. So we do think that there should be an eye on fiscal consolidation. I think as you mentioned, consensus numbers are also closer to 5.8 or 5.9. So everybody is sort of building in a gradual fiscal consolidation path. This is not a very aggressive fiscal consolidation path, and therefore I think if there is a slippage which is numbers which are say 6 or above 6, that would probably be a tad negative for the market in terms of the starting points itself being so elevated for India.
Sure. So we talked about this briefly, but tell me, what is the sense you get on employment, and what do you think that the budget may have in store in terms of addressing the employment issue?
I think given India's demographic dividend, employment and employment creation remains should be the key focus for policymakers. I think from both not only the budget but an overall economic agenda perspective. And I think now, if you take a step back and see what the government has been doing in the last, say 3-4 years odd, with the reduction in corporate tax rates and then the introduction of production-linked incentive schemes and pushing public capital expenditure higher through the budget, and aggressively allocating for capital spending in the budget, it does show that their intent is to promote the investment-led growth model, and that bodes well for employment generation or creation in a country like India where there is surplus labor. So in our view, the budget, I think, will also focus on jobs and employment as one of the key themes, but and the way it will be delivered, or the way jobs will be created, will be through higher capital spending or public infrastructure led spending, and also probably some measures on the to promote private capex. So as it's incentivizing manufacturing through production linked incentive schemes, there could be possibility of say higher allocation for PLI, or maybe introduction of some new schemes, new sectors in the PLI scheme. So all of that can also happen outside of the budget, but obviously budget does provide you a good platform to announce those sort of measures. But bottom line, we think that for employment creation, the focus should be on capex and capex led growth, which then creates the virtuous cycle, and you get the job growths as well within it.
Sure. So on the consumption demand side, Upasana, I mean, there is an expectation that, this is an expectation that comes up every year. Everybody wants tax cuts. So asking for more, personal income tax benefits to ensure that, this demand that we've seen last year can be sustained going into next year. First of all, do you expect that to happen at all? And secondly, how important is that to actually to incentivize demand at all for this year?
We don't expect any changes in tax rates, and you're right, this always comes up during the budget. So we definitely don't expect any tinkering of or lowering of the personal income tax rates to sustain consumption or demand. And in our view, the best way to actually create more demand or more sustainable demand for India will be jobs and employment creation. So as you create more jobs and employment, income growth will go up, and that in itself will create your virtuous cycle of more consumption and more investment. Tax breaks per se, that will not really have long-term benefits from a multiplier perspective as well, but rather the multiplier effect of capital spending of the government could be better off and could be higher. So I think that would be a better strategy to for the government to focus on in terms of promoting medium-term growth potential for the economy.
Sure. Do you expect any surprises? Of course, surprises are not to be expected, but
Yes, you're right. So it's difficult to say what surprises, but you never say never. And I think budget is one such event risk, so to say, when you that you have to sort of deal with. In terms of risks or factors that could impact markets, I think any changes or tinkering with the long-term capital gains tax, that's the only thing that comes to my mind, which could have, sort of volatile reactions from the market. That's something that needs to be probably looked into, rather tracked in the budget.
fair enough. And looking at growth itself, what do you see as the biggest risks to growth? Of course, there is one side which is global, so you can articulate on that also. But are there any visible domestic risks to growth?
Yes, in terms of risks, I think you mentioned it correctly. The global risks are more pronounced right now than domestic or cyclical risks in our view. Why we say that is because, if you look at the balance sheet positions or the debt levels in the private sector, they are probably, the balance sheets are probably at the best in the in last 10 years. Corporate debt to GDP is at 16-year lows. Impaired loans are tracking at 10, 11-year lows. The external balance sheet of the economy has also now improved, but nevertheless, and therefore, we don't really see domestic or structural risks per se at the moment. The risks stem mainly from external factors, so global growth slowdown, changes in global commodity prices, because India is a net commodity importer, and that's not going to change very quickly. That has repercussions on our external balance sheet metrics, and therefore on liquidity and financial conditions as well. And lastly, the overall global capital market environment and its repercussions. So I think mostly the risks are skewed towards the external sector or external developments rather than domestic at the moment for India.
Sure. And what is Morgan Stanley's house view on crude?
So we do expect crude to increase from current levels, and that is driven by the supply side issues, or the supply side being more tighter than demand. So that's our house expectation, that crude oil prices will go up from here, probably closer to $100 per barrel for in this calendar year.
$200 per barrel?
On an average, yes.
Wow. So that will pose a huge risk, isn't it?
See, on a YOY basis, numbers would then be flat if you look at fiscal 23 and then fiscal 24, because crude has averaged close to those levels. And obviously, there are a lot of other demand and supply factors which come in and which can impact finally how the oil prices will behave. I think predicting oil prices or commodity prices has been fraught with a lot of volatility, especially recently.
Sure. Now, this is one question that has a lot of repercussions for the rupee. First of all, what is your prognosis for the rupee? But more importantly, where do you see interest rates headed in the US? What is Morgan Stanley's view? And today, if you see the differential between interest rates in the US and India is really at a multi-year low, perhaps at a 15-year low. Does that pose a risk to the rupee going forward?
So on interest rates and what happens to financial conditions globally, our view, and therefore on rupee also, our view is that for US, probably we are nearing the end of the rate hike cycle. Our US team is expecting US Fed funds rate or terminal Fed funds rate to be around 4.625%. So Feb should ideally be probably the last of the rate hikes. And with that view, and if you look at also global growth conditions now, looking a little better than what was probably anticipated, with China reopening, with some of the high frequency data coming out of Euro area, it does look that again the US dollar has also peaked. Our FX strategy team also expects the US dollar or the DXY index to depreciate this year, and that bodes well in a way for the EMs as a whole, and also then for India. So on rupee, our FX strategy team expects a mild appreciation going into calendar year 2023, driven largely by the dollar moves. But we do also anticipate that as the opportunities arise and capital flows, increase, there will be tendency for the central bank to build on FX reserves, which could then moderate the extent of appreciation that would happen. But overall, we do think that the external environment has sort of improved in favor of EMs, with lesser pressure from financial conditions tightening, and also also in terms of incremental expectations going forward.
Sure. So the other part was, do you see any risks to domestic growth?
So risks to domestic growth, I think, essentially stem from if there is any sort of changes and probably policy decisions by the government or otherwise. So what we are seeing is that there's been a great focus, as we've discussed all through, on capital spending and capex. And if there's any change, I think, in that growth mix, wherein there's a flip towards focusing more on redistributive spending, and that then creates macro stability issues in the form of inflation, etc. I think that is going to be a key risk that we think can hamper growth more, not only near term, but then also more perspective. There's any change in the growth mix from the current model.
Sure. Upasana, last 2 years, if you see, India has really surprised both on growth and taxes, and tax collections, obviously GST tax collections, whatever they projected, it has been much better, this fiscal as well as the last fiscal. So going into FY24, do you think the risks to growth are more, that we will end up beating the numbers that we are thinking about today, or there will be greater risk in terms of moderation?
As I mentioned, risks stem mainly from the external factors, so global growth slowdown and changes in commodity prices or capital flows, etc. I think given that there is still high level of uncertainty on the external environment, we see risks for fiscal 24 skewed to the downside, but mainly driven by global global scenarios or external developments. So if the global growth expectations turn out to be worse than what we are building in, i.e. Morgan Stanley's house view is not of a US recession and therefore global recession. But if we were to see something like that, I think that will then create further downside risks for the economy. And that's what we are sort of highlighting, that probably risks are skewed to the downside, but mainly driven by external factors rather than domestic.
All right. Thank you so much, Upasana. It was lovely talking to you. Thank you.
Thank you. My pleasure.
1st February 2023, the Finance Minister Nirmala Sitharaman will present the last full union budget before 2024 elections. India's most awaited financial event comes in the midst of global slowdown, inflation, liquidity tightening, geopolitical tensions, and re-emergence of COVID-19. Will India look to fire up its manufacturing? Will India build a moat against global uncertainties? What will the budget have for the middle class? Watch the complete coverage of Budget 2023. Real-time analysis, expert takes all day on Moneycontrol. Log on to www.moneycontrol.com for more.